And it is Wednesday, 5/5/2021, and it's our daily show we call the Halftime Report, where we go through the markets one step at a time, looking at charts, news, information, economic data, sectors, individual companies, breaking down earnings reports, pretty much anything we think is relevant, important to the financial markets that day to help us better run our daily routine, analyze it, and get it out there to you guys out there as our halftime crew. And we are posting this as a recording today. We had a little issue going live, not a little issue. We had an issue going live on YouTube. Still trying to problem solve and identify what that is, whether it's Zoom or YouTube or Google, or we don't know yet, Matt, but we never let our halftime crew down. So we're going to record and get this uploaded in a different fashion. Let's start with Matt. How you doing today, sir?
Tim, doing good. I wish I could have been with the halftime crew. I really enjoy, being there live with them. But as you discussed when we had our audio or our technology problems connecting Zoom and YouTube here today, you're like, hey, we got to get this out there. Let's go. Let's go. And so, no, I'm excited to be here, but wish I was with the crew live.
And Tyler on a Wednesday. How you doing, sir?
Yeah, I agree with Matt's sentiment. But excited to be here and break down the markets. Lots to talk about. Yep.
Absolutely. Looking forward to it. So let's get right down to business then, guys, and let's kind of, get the analysis out there so that people can absorb it and use it for their daily routine. Let's start with technical analysis here. Tyler, yesterday, markets sold off a little bit. In fact, the tech sector and the NASDAQ were the ones that were leading the charge to the downside and had a pretty healthy sell-off, changing character in the chart a little bit. I'll get your read on that. But at the end of the day, we had a little bit of a bounce going into the close. Even the Dow Jones Industrial finished in the green. Today, you got a pretty healthy little market here. In fact, the energy sector looking really good. Basic materials again looking very good. Just your broad read on the technicals here, Tyler, and market conditions.
Yeah, it's interesting. You're starting to see a tale of two markets. Growth stocks, tech stocks got smoked yesterday. And to your point, the Dow was up. I always view corrections like that where it's one area falling out of favor, another area coming into favor. Those are less scary types of downturns in the market than if everything was getting beat up. And also the lack of follow through today. Tech's not as great this morning, but the S&P is right back up, the Dow's up. So I think you got to be pleased by the lack of downside follow through, and you have to be pleased that money that was fleeing tech yesterday was finding a new home in cyclicals and mining stocks and everything. So today, so far so good. S&P's above the 20 MA. A little reprieve after yesterday's big down move. I wouldn't mind a small candle here to bring a little bit of conviction and confidence and stability back to the market. I'd still kind of view the S&P as just consolidating. Perfectly fine for me. I just think the victory here was closing above the 20. Look, if you take out yesterday's low, then we can talk about something more substantial. Until then, I think this is just a shuffling of the deck this week.
Yeah, and I do think that's a really good line in the sand, actually. I came down intraday and did test those 4120, 4100 zone. It's down there. I know it didn't get all the way to 4100, but Matt, you had highlighted that yesterday. S&P holding up. In fact, holding the moving average here and looking still in a very similar pattern that it has been over the last couple of weeks. What's your read on the S&P first before we talk about tech?
Well, what we talked about yesterday and what was kind of leading towards this sell-off in the market yesterday, and we combed through the news, we combed through the geopolitical situations, we combed through everything, and even though the market kind of just adopted, the market's going down because of what Janet Yellen said, that wasn't my read yesterday. I kind of felt like this was a technical sell-off that created some volatility out of the European markets that led to an environment where there isn't a lot of trading. And what we saw was about 2 hours yesterday before the market even opened. It was about an hour before you start to see some action in the market. Typically, it's 30 minutes before you see any economic reports come out to the market. And so we started seeing the selling in the midday yesterday during the European hours. That had a tendency to violate that intraday support where there wasn't a tremendous amount of action, really kind of light volume as that started initially driving down. And so you're really looking at this from a technical sell-off perspective. And my read yesterday in the halftime report was very, very simple. When you violate support on a technical event, or even if that technical event is led by a catalyst, typically what you're going to see is you're going to see the market come down to that next level of support. And that next level of support lines up right in that 4100 to 4120 level. What did the market do? It found that next level of support. Now, that never got violated yesterday. You found support, the market recovered, and that's very important, because if there was going to be follow through, you could have seen a very similar scenario yesterday in the S&P as you did in the NASDAQ. And when you're looking at the NASDAQ, if we can go to the NQ contract very quickly, and we can look at this on a daily chart, you're seeing the NASDAQ violate a support level on a daily perspective. You see that level, that same level on the S&P. Now it's like 13,700 on the NASDAQ, but that same level gets violated. And what does the NASDAQ do? It comes down to that next level of support. And so the identification of support is so very important in these types of moments. It's important in every technical moment, but especially in these types of volatile moments, because what we're trying to understand is this simply a technical moment of weakness, or is there truly something fundamental happening when you see these days like we did yesterday? And obviously, we're immediately going to go back to what happened in February in the NASDAQ when you were having the bond market puke up, the inflationary conversation. The NASDAQ went into correction territory. It dragged the rest of the indexes down to the point where the Russell 2000 has still not recovered the price action from what that transpired. And so it sparked those same degree of fears. But again, when we were looking at this yesterday, and there was a lot of news out there in the market yesterday about that same fear building, Well, was the bond market showing that same fear? No.
No.
Was the cyclical areas of the market, energy, industrials, finance, basic materials, showing that same degree of fear? No. And so when you're looking at this from that perspective, you do not see this as a broad market sell-off. You see this as a little bit of rotation that obviously is concerning to the NASDAQ. You got to like the fact that it found support, but you're still seeing this as some rotation, and obviously it's going to be the beneficiary at least the last couple of days, and probably moving into the foreseeable future is that cyclical area of the market.
Mm-hmm. Yeah, and it's a really, really good point, especially on those cyclicals. We were even talking in pre-production about the energy sector and some of the strength it's showing here today. The Dow Jones Industrial here pushing towards a new high. Where the strength and the weaknesses in the market is becoming apparent in the short term. Tyler, any read on the other indexes or sectors you want to add to Matt's analysis here?
No, I mean, just pointing out that the Dow is strong, just so strong. Didn't budge yesterday, so. No, I don't think I have anything else. Small caps are still nothing burgers right now. Still trying to just get out of their slumber here. So, yeah, I don't have anything to add.
Let's round up commodities then and take a peek at crude oil. Crude oil has been so healthy over the last month or so after some volatility there in early March, brought it back down to the 50-period moving average, developing trend, higher pivot high, higher pivot low, higher pivot high. We are now pushing up here towards a resistance zone here, Tyler. Tyler, give me a technical read first, if you can.
Look how well this is behaving on my lines. I just love it. I just love it. Yeah, I mean, you're wrestling with a little bit of overhead resistance here at 60, 66, 67. But look, I mean, it ran from 60. It doesn't look like it, but this thing's up 10% on this swing. So if it wants to back and fill here or settle for a little bit, I don't mind it. I think you've got to be encouraged by energy stocks, despite the fact that crude oil is encountering a bit of resistance. Energy stocks are doing quite well today. So I think look, XLE is up almost 3%. Who needs crude oil, Tim? Who needs crude oil to go up? Nobody. We don't need it to go up.
I think it's a hold, brother. Honestly, they don't need it to go up. They don't need it to go up. If you hold $66 a barrel for these companies, we've seen their earnings after Q1 here, Matt. I think they're going to be just fine if they can keep prices up here in the 60 range.
If the average price of oil goes from 47 in December to 52 to 55 over time, this is a very healthy fundamental argument for the energy sector. And it's felt like for the last what, 4 or 5 months, really since the beginning of the year, the entire argument that we've had at Tackle Trading on the energy space itself was the stabilization of oil. And if oil does stabilize and you see that price of oil going up over time, we don't call that inflation, we just call that price appreciation. But when you see that going up over time, that's going to have a fundamental impact on energy earnings. And we all know how important the average price of oil is to the profitability of earnings. When you see oil in the $40 range, energy companies have a really, really difficult time. When you see oil in the 50 range, they're doing okay. When you see oil stabilize above 60, man, that's prime. Oil companies are not only going to do good, they're going to give back to the investor class, like we saw out of Dutch and like we saw out of BP last week, and what we saw a little bit out of Chevron just a few days ago. So, that argument of energy catching up to oil and the stabilization of oil's price over time, it's just playing out the way we anticipated. It's been a choppy environment over the course of the last couple months, but the fundamental argument has played out, and that's been very powerful.
Yeah, and very healthy for these oil companies. And, I love that chart on XLE you were talking about, Tyler. There's a lot of good components in there. And I think we're going to run a little exercise we call Jedi options a little bit later in the show. And I believe you've got some ideas around the energy sector was one of the areas of focus. Is that right?
I do. Yes. So stay tuned on that.
Yeah, we'll get there shortly. Gold real quick here. Not much to add to the chart here on gold today, Matt. As long as we're holding that 1750 line, I've been told I can be just okay here. That's the analysis we've been looking at for quite some time. I love those lines too. In fact, your lines are well behaved here today, Tyler. Look at that 1800 zone. Obviously we got that breakout point. Support is holding. The old pivot point is there. Tyler, quick technical read if you can.
Yeah, I mean, the fact that the lines are holding says less about me and more about gold, right? I mean, it just tells you that it's being well behaved, which kind of means you can have a little more confidence on the signals, I think. Meaning a break above 1800, I'm more optimistic about than I would normally be on a typical breakout. I like two things about gold this week. I like the pop off the 20, which I'm sure you guys talked about. Gold and gold stocks got caught up yesterday with the sell-off, but I do like how they did not take out the prior day's low. They stayed above the 20, little hammer candle here. At the risk of reading too much into short-term price action, I just like how buyers are defending that pop on Monday. So any consolidation's fine. I'm with you. Just don't take out 1750 and we'll be fine.
Yeah. Matt, anything you want to add to gold here?
No, price action has been fairly healthy. It's lined up very good with with historical technical analysis, and quite frankly, that $1,800 level that we talked about, over the course of the last, really the last couple of weeks, but even yesterday, that sell-off, that happened in the market, tried to violate 1,800, hit it on the tick. I actually took that as a positive yesterday. And it just showed me how important that 1,800 zone is, quite frankly. And even though it's going to be a battle, it'll be a battle. I do believe that gold will win that battle, and that $1,800 breakout is going to be really, really good.
I agree with that, and we're going to be eyeing that 1,800 level for potential trade.
And by that's not confirmation on the reversal. That's secondary confirmation on the reversal. The confirmation happened above 1750, and that's why 1750 is so important.
Yeah, those pivot relationships really teach you a lot about technical analysis, quite frankly. The higher pivot high, confirmation breakout. Now we're holding it. Yeah, it's clean.
Honestly, it's a simple analysis on gold right now. If you're in, you're just in. You're in. There's nothing that's going to shake you outside of that fundamental concern on inflation. If you're not, and even if it violates 1750, you're not going to do anything on your long-term holdings on gold. It's the short. It's to the investors that aren't in yet. That 1,800 zone is really, really powerful as a potential trigger on entry. If it violates 1750, you're just back down to neutrality. It's not a bearish indicator at that point. You're back down to neutrality, which means the investors are just going to go back into writing covered calls against GDX or GLD or whatever they do from a cash flow perspective. It's the new traders that are looking at that 1,800 zone. The old traders are like, yeah, we've done this a million times.
Yeah, I think it's a good point as well. Next one here, real quick one on Bitcoin. Then I want to finish on the dollar before we get into stock talk. I know Matt's got a few earnings to round up, and then we are going to have a little segment we call Jedi Options here in just a few minutes. But Bitcoin, nice little bounce today. Anything between 45K and 65K in the short term, though, this whole thing is just kind of rolled over for me. There's a lot of chatter around Dogecoin lately. I just don't get it. Not getting even acknowledge all that wildness for too long. But little healthy bounce here, Tyler. Anything you want to add to the chart? I think there's nothing burger until we get more clarity, personally.
I just, Bitcoin's not behaving as well as gold. I have to redraw my lines, and it really ticks me off, to be honest.
I don't like redrawn lines either. It drives me nuts.
Behave yourselves, Bitcoin. It's fine. I think you got to be pleased. If you were freaking out with this sell-off a week and a half ago, you got to be happy with this constructive price action. There's a lot of strength in Ethereum and those other ones too, right? So yeah. you would hope that this holds its own while those other guys are doing well. So yeah, it's good. I mean, in the short run, if it can start to fill the gap, you've got a pretty clean run up here if it'll take out the highs.
You're going to trigger a rant from old Tim over here. That's my frustration with all the madness in the underbelly of the cryptocurrency markets and the Dogecoin craziness, Matt, is that even Ethereum just gets lumped in with the other ones.
Yeah, and it's not like you got your memes, right?
Yes.
I would not call Ethereum or Bitcoin a meme currency. I just wouldn't. And I kind of feel like what the Winklevoss twins did today with trying to lump all crypto into meme currencies to try to justify their Dogecoin decision to allow it on their platform was a very big mistake, because at least for me, I do not see Ethereum, Bitcoin in the same light as I see Dogecoin and some of those other altcoins.
Yeah.
And so it's just, I just don't feel it's the same analysis. And I do not feel like it's appropriate to lump them all into the exact same category. That's like saying that the Thai baht and the dollar has the same form of analysis on it.
That's right.
And I'm sorry to break the bad news, but I wouldn't take the baht over the dollar. And I wouldn't take altcoins over Bitcoin long term. You can't put them all into the same category simply because they're loosely tied to the same industry. Quality does stand out.
Yeah. But with the Ether comment though, Tyler, Ethereum /ETH is still holding up and looking very, very strong near all-time highs. And I love that.
Starting to form a high base at the all-time high. Like,
beautiful thing.
Strength on strength in Ethereum right now.
Ridiculous.
All right, last one is the dollar here, and it will prompt a conversation about inflation. In fact, Chicago President Charles Evans of the Chicago Fed actually said the inflation risks he believes are not going to get out of control there, Matt. Governor Michelle Bowman suggests that inflation running above 2% still seems very small likelihood that will be a problem. And this is after a day where Janet Yellen mentioned that inflation probably needs to heat up. In fact, interest rates should probably go up because of inflation. I should correct what I'm saying there. Yellen had those comments earlier in the day, and then she had to backpedal on it. What's going on with Yellen and the Fed in the last 24 hours? Well, even for them, this is something.
Yellen was asked a question. She gave an honest response to the question, and people freaked out over the fact that interest rates might have to go up in the face of a CPI report, a PCE report, and other inflationary concerns that we simply have not had in this cycle. And even Buffett in his address on Saturday talked about the inflation, and he's one of the biggest home builders. He owns one of the biggest home building companies out there. And he's talking about inflation being up, and up. Janet Yellen was asked a very honest question, which, by the way, again, I'm not sold on this belief that it was inflation yesterday. If it was inflation yesterday, the market would have responded on Janet Yellen's comments. If it was inflation yesterday, the bond market would have responded. If it was inflation yesterday, other asset classes would have responded as well. And so I'm not there. I don't believe that storyline, quite frankly, but let me just talk about it. Janet Yellen was asked a question on inflation. She gave an appropriate, honest response to the question. And this is what I am now speculating, because she has backtracked her statement, full stop. And you've had a coordinated effort out of the Fed to say no inflation today. she was basically told she does not work at the central bank and she does not make decisions for the central bank, and she had to backtrack a little bit on that. But my thing is, Charles Evans, you're wrong. You're wrong. You know you're wrong. You full stop. Tackle trading. Charles Evans is lying. He is lying. Janet Yellen gave an honest response to an honest question, and the Fed does not want that conversation out there. The Fed wants it to be hashtag no inflation, hashtag transitory, hashtag transitory. Let me say transitory as much as I can. Inflation is not a concern. It's only for right now. Don't worry about the future. The future is going to be great. I'm sorry, that's not how inflation works. That is not how inflation works, and that is not how inflation has ever worked. You cannot create this pool of money and then just say it's just going to be transitory when you don't shift your policy. It's transitory if you raise rates, because that is the cure to an increasing in inflation that you're not seeking. And so, yes, I feel like the Fed is completely full of you know what right now, and they're not being truthful. They're not being transparent. Janet Yellen gave an honest response to an honest question, and quite frankly, I'm not sure that had anything to do with the market yesterday.
No, even the timing of it, I didn't think that was what it was either. And we kind of talked about that, but
everybody and their dog is going to try to find causation, because causation allows them to write their headlines. Causation allows their mind to wrap around the reason for something in the market. And yesterday, when you have those reports we saw yesterday, great reports coming out of corporations from an earnings perspective, economic reports were fairly decent. You had positive news after positive news, and the market was puking up yesterday. Traders, Wall Street, everybody's going to try to find a reason for that, even if that reason does not make sense from a timing perspective. And in my opinion, it does not make sense from a timing perspective. But because inflation is the topic of conversation for market participants right now, that's what we're going to wrap this storyline around. But again, what sold off yesterday? NASDAQ, comms, discretionary. NASDAQ, comms, discretionary. Nothing else. Bond market did nothing.
Tyler, do you have any thoughts around all this chatter with Yellen, the Fed, these inflation conversations that keep creeping up?
Well, we talked about this pre-show. I think it's almost like she opened up an economic textbook and said, "Well, this is what we've taught for a century." Just FYI, in case you didn't know, inflation causes rates to go up. Yeah, so I don't know. I mean, yeah, I agree with you. I think that it's a bit of a nothing burger. And she was a Fed chair, was she not?
And the vice chair as well.
I did think it was interesting, the one comment she had, Matt, at the end yesterday. She said, if anybody appreciates the independence of the Fed, I think that person is me. So she must have got a phone call saying, you don't work for the Fed anymore, Janet Yellen.
She got a phone call.
Yeah, for sure.
But isn't it dumb? Isn't it dumb though that things are so sensitive that you can't even give an opinion on something without the market freaking out?
It's ridiculous, Tyler.
It's so stupid.
It's ridiculous. And yet, what did Yellen say? The only thing she said was the thing everybody that has ever been taught anything about market cycles, interest rates, inflation, deflation. She gave a textbook answer that should have not been concerning to anybody. It was not eye-opening. It was not deep thinking. It was literally nothing. Hey, ask me a question on if inflation rises. Ask me a question.
Hey,
Matt, is the sky blue? Matt, is the sky blue?
Not today. The sky is really, really black today.
I wonder if she had a pause and internally she's like, okay, do I want to say something stupid or do I want to say the obvious here?
It's really simple. Hey, with the increases in inflation, what standard policies do you guys have at your disposal to combat inflation? Well, the simple reality is the number one tool we've had at our disposal for the last 107 years is increasing that interest rate. And
Yeah.
anytime we see these short-term impacts on inflation, what we do to maintain the stability of price action, which is our number one principle at the central bank, is to raise or the central banks, because it's Janet Yellen no longer, right? But the number one tool at the central bank is to adjust the interest rate in the short term to suck out the supply of the money so that we can have a more stable price action moving into the future. What's wrong with that answer?
Nothing.
Well, and by the way, historically, when rates go up, the stock market still goes up, right?
Yeah,
It's a byproduct of a healthy economy.
Tyler,
Yeah.
for literally 2 years on average, the market continues to
Yeah.
go up before you see this spark, right? That
Yep.
is typically some catalyst, but it's not the interest rate that is the catalyst. Take, for example, what happened in 07, 08. We started raising rates in 05, not in 07, not in 08. We were already decreasing the interest rate in 08 before these things occurred. In
Right.
1998, we started adjusting the interest rate. We went from 2% all the way up to 6.5%. And yet that happened from 1998, right after the Asian currency crisis of 97, 98. We continually increased the interest rate from 98 to 2000 multiple different times, and the market continued to go up because the
Yep.
sign of interest rates going up is a sign of, yes, inflation's a concern, but we're also confident in the economy to continue moving in the right direction. Whereas right now and over the last 12 years, everything in monetary policy is about what is happening in price discovery in the stock market and not from an economic perspective. But when you look at these economic numbers over the course of the last 6 months, I've never seen this in America.
If the
This,
economy was a person, don't you think they'd be offended?
if the
But
economy was
you
a
think I
person,
can't handle this, Matt? Raise the rate a quarter
put them
percent. I
on
can
my
handle
broad
this.
shoulders and let me, you need to jump on my back. Let's rock and roll. Let's do this. I mean, when did we get so paper thin and fickle in America that we can't handle anything negative? Come on, pull up the britches a little bit. Get the job done. Raise interest rates and deal with it.
Agreed.
Yeah. They're not going to do that. So.
No, because they're a bunch of cowards.
They are.
Charles Evans is an absolute coward, and it is obvious that Janet Yellen was told to stay in her lane, and that is just ridiculous to tell somebody of Janet Yellen's experience, Janet Yellen's expertise, and what she brings to this conversation, and to tell her that I just felt it was completely wrong.
A little bit of mixed messaging over the last 24 hours, but I think the real message is very clear, and they're just trying to keep this craziness within the penthouse. So let's move on. Let's go.
Can I say for the fourth time the Fed is lying?
Yeah,
they're lying about this transitory issue. They are concerned about it.
Yeah, of course they have to be. They're economists. I mean, come on. Let's move on to our earnings roundup here next. And there's a couple of names that grabbed my attention here this morning. Matt, if you want to just kind of rapid fire through them, let us know what you saw in the.
Yeah, we got quite a bit of names, quite a tremendous amount of names that actually reported here today. Let's talk about a few of them. Let's go to Tackle 25. Activision here reports ATVI. Activision has been struggling a little bit just in recent history. Last quarter is, I don't want to say it's been bad. It's just done nothing. But in a world that goes up, 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 right? I mean, come on, Activision, get your act together a little bit. They're starting to get their act together with their earnings numbers. Now, the price response is very volatile. I want to get Tyler's take on it. But the numbers are perfectly fine here. 69 cents versus the expectation of 65 cents. Revenue came in line, but the biggest thing was the increase in revenue. So, Tyler, a passable grade here on Activision. Pretty lukewarm on the raw numbers, but a beat officially. Increasing guidance in the short term was decent. What do you think of the price response, though?
Yeah. Look, they sold the gap. This is what we call a gap and crap. It gapped right up to resistance, tried to break through it, came right back down. Dude, this is a mess. You got to wait a few days. You got to let this thing digest it. Could have been different had it gapped and run.
You know what it reminded me of, Ty?
What?
You know what the price response reminded me of today? A little bit of AMD from a week ago.
Yeah, exactly.
Little AMD. If you pull up that chart, if you'll remember, AMD gapped up on some positive numbers, immediately sold back
smushed
down, and you know, the next day, people are looking at that next day being like, oh man, look at that hammer candle. I just think it's a reminder to be patient on these types of volatile price movements in any market.
It's not even unique to AMD. I mean, a lot of the tech stuff, just great earnings didn't move much. I think the market, like you said, is telling you, look, be patient. This may go higher, but not right this second.
Yeah, I don't think there's anything here in the short term, and I do think you got to see the volatility kind of subside here on Activision. But again, numbers wise, they were nothing wrong here. And on a day when earnings was very mixed, guys, especially at the bottom of the market, you had some nasty gap downs in earnings today. Some nasty gap downs. Activision kind of bucked that trend a little bit, but it was very mixed on an earnings response day here today. Let's move on to General Motors here today. General Motors comes out today and posts a very decent EPS number. Revenue numbers came in line. Guidance was maintained. Let's go through the raw numbers very quickly. $2.25 versus the expectation of $1.02. Revenue came in right in line at $32.5 billion versus expectation $32.7. They also maintained guidance. Revenue was basically flat year over year. I'm fairly certain there's some funny math in that EPS beat, because that EPS beat is really sexy, and this earnings response is not really sexy. A little bit of price up buzz and just kind of doji there, Ty. Passable grade though, came in line with revenue. EPS did beat. I'd have to dive into the EPS number to see that type of beat, but very overall kind of a maintenance here on earnings.
Agreed.
And the price is kind of maintenance here on the price response. Tyler, do you see anything in their technical response?
No. And you know, given the current market, you gotta show me something to bring me in, right? Yeah. Like this is not the type of environment in light of this week's sell-off where you want to try to be a hero and anticipate breakouts and such. I'm not interested in this unless it breaks out.
Yeah, that's kind of my thing. And you know, in the market recovery post-pandemic, the head and shoulders formation has been a fairly it's been a fairly popular pattern, I would say, but not all the time has it confirmed to the downside. A violation of that right shoulder on the breakout has been a legitimate trade as well. Yep. I do think at this point, when you look at these head and shoulder formations, you're looking at the right shoulder, you're looking at support at 55 on GM. I think you're looking at K trade analysis. I think you're obviously concerned at the 55 violation, and you're looking at that right shoulder saying, okay, there might be a trade above that 59 level.
Agreed.
All right, gold next. A little Barrick action here today. Barrick Gold, one of the biggest gold miners in the world, comes out at 29 cents versus the expectation of 26 cents. Revenue came in line at $3 billion. That was also the expectation. That resulted in an 8.6% revenue increase year over year. You know what? Their price response got it right. This was a very neutral report, and you got a doji on the price response. I don't see anything in that chart, Ty.
I would agree. I think here's what you have to like, though. Newmont Mining, when that sold off last week, that took the whole sector with it. I think you have to maybe breathe a sigh of relief that you didn't have a big negative response to kind of disrupt this recovery in gold miners. So
great point.
From that perspective, I think this is a win.
Yeah, Newmont, Barrick, the two biggest players out there. Newmont brought it down. Gold kind of or Barrick kind of stabilized it. Great point. Love it there. Let's move on to T-Mobile here. T-Mobile comes in at 92 cents versus the expectation of 55. Revenue came in slightly above the expectation as well. That resulted in a fairly decent increase in revenue year over year at 72.8%. Looking at nice little potential breakout here on T-Mobile, Tyler. I'm looking at this price response positive. The EPS number is very, very positive here. Revenue's decent, but the revenue year over year very positive as well. There, you gotta like the price response. Where would you consider this a confirmed breakout?
Yeah, well, 135.54 is the highest it's been for the last 4 months. So I think you take that out, and that confirms you've gone where no prior rally has been able to go, at least in the last 4 months. So shoot, I don't think you overthink it. I think you just pick the tippy top. It's close enough to all the other candles that's probably your line.
And
I have to do this with T-Mobile at some point, though. Go ahead and finish, but I want to get a long-term chart, Matt, at some point.
well, yeah, I wanted to get a weekly chart on T-Mobile as well, because I wanted to ask Tyler, breakouts on the weekly chart. What's his read on breakouts on that weekly chart? If he sees that as historically a really good opportunity, or is it, or because sometimes we see breakouts in stocks that break out but don't do anything, right? They break
Sure.
out, they just stay there. They break out, they fake out. But I just wanted to get Tyler's, because we're looking at a weekly breakout here is what we're looking at. And we always like weekly breakouts, but does the analysis on T-Mobile support it?
Yes. With the analysis meaning the fundamental or the
No,
chart
no,
read?
the chart read on a breakout.
Yeah. So yeah, I mean, what would give you confidence here is what has it done on the past few breakouts, and what's the sector look like? So to me, I mean, this has a pretty good history since really the breakout that
I mean,
kicked you off
that
last
one was
year, right? I mean,
pandemic. Yeah.
yeah, and even then, I mean, think about it. Like this held up pretty well.
Far better than the market did.
Oh yeah. So I think you got to be impressed. I think you got to be impressed, especially compared to it's like T-Mobile is a growth stock, Verizon and AT&T are like consumer staple stocks.
Because they kick the dividends back, right? I mean, it's the nature of how the company wants to operate and interact with its investors. But yeah, I like the T-Mobile long-term breakout potential here. I don't know. It's just not a great trading stock. So I'm thinking position trade.
No, but it's
Yeah.
position. It's not a swing trader stock,
it's not.
right?
Yeah, I mean, like when's the last really good swing trade in the last 6 months? You don't really have one.
In comparison to maybe Verizon, it's a good swing trader stock.
Fair point. Yeah,
but
fair point.
but it's still
It's
not.
worth pointing out though, like AT&T starting to make a move, or Verizon's showing a little bit of strength the last 2 weeks. So this general area has not been the NASDAQ. That's for sure this week. Like this area has held up well.
Yeah, I think that breakout of T-Mobile's got to be looked at, especially post earnings. Now, let's move on to Zillow, ZG. Zillow violating that support level, 200-day moving average, historical support. We'll get Tyler's read here in a second. Zillow comes out 47 cents versus the expectation of 25. Revenue came in line. That resulted in an 8.2% increase in revenue year over year. Problem, those numbers are not good enough for a company like Zillow. That's number one, especially with what we know about the industry Zillow has been tracking and how hot that industry is. But the problem, and this is a slight problem, but it's it's fairly rare in the market this quarter. They have a slight decrease in guidance. And it was, when I mean slight, like Zillow, you were too honest. You were the opposite of Charles Evans today. You were too honest with your numbers, and I give credit because I see too many times where it's like, it's just a couple pennies, but they decreased guidance officially. So the raw numbers, EPS numbers fine, revenue numbers not good enough, revenue year over year not good enough, and the slight decrease in guidance in an environment where we're talking inflation and up, just simply not good enough, Tyler. Price response also fairly negative here. What's your read?
Dude, this is gross. And you'd think, oh, it's gone from 212 down to 110. I mean, it's already down a lot. Yeah,
You'll like it at 60.
Dude, I mean, pre-pandemic, this thing was $50. So
and it didn't move, like it was like 30 to 50, 30 to 50, 30 to 50. If you don't think this doesn't have more room to come down, you're wrong.
And this has been the story on all the growth stocks: Zoom, Teladoc, Peloton. I mean, all of them just completely got out of hand, and now you're seeing this unwind. This does not look good. I mean, if I was bearish on this is what you've been waiting for to trigger into something.
If this was 2019, I would dare say short Zillow.
The pattern's there. There's
The
no
pattern
question.
is beautiful.
Now
You
your
have a
post earnings.
horizontal support level, a decreasing resistance level. That is an inverted cup and handle or a descending triangle coming into a 200-day moving average, whereas typically that is seen as a battle zone. And on a negative catalyst called earnings, you violated everything on a no-sell day. I'm actually surprised it's not down far more than 5.5% right now. So again, completely understandable anybody that's selling this today, just not justifiable given the fact that what it was doing before the pandemic, and these numbers just don't justify where this stock is at this point.
Yeah.
All right, next let's take a look at one of Coach Mark's favorite, Caesars, CZR. Caesars is a dirty, sexy man candidate for 2021, and it's had a fairly decent start to the year, up about, 25% in the first few months of the year. So a good start to those Caesars.
I love 2020. 25% starts on dirty, sexy money is like, all right, that's
not good enough.
Okay,
what are we at?
25%.
4 months, but we're 4 months into it. Dirty Sexy Money averaged about 92% per stock last year. We're on pace to actually beat that if you take into account Caesars. But you are right. It's up 25% on DSM. It's like, so? Like
Dirty Sexy Money has had such
better,
a monster
bro.
16-month stretch that, listen, it's going to start getting attention outside of tackle trading if it keeps up these numbers.
Listen. It's hard to impress these Dogecoin kids. It just is. It's like a new generation. They all are just so spoiled.
That's fine. Let's just wait till they get Zillowed, and they'll realize the beauty of DSM there. The meme kids should love Dirty Sexy Money. It's right up their alley, right? But no, DSM's been. I don't know of an area of the market that's been more rapidly on fire than DSM. Find me it. I challenge you. Find that. But Caesars, $2. Their actual raw numbers are not good here. But again, we're talking about an area of the market that that didn't just get hit, that got shut down. Full stop. Shut down. Caesars, right? Gambling, entertainment, that type of stuff. Their path to recovery has not been as quick as their price recovery. And we see this in the numbers here today as well. Caesars reports they were expecting about $1.80, a negative $1.69. They missed at $2.06. Revenue was supposed to come in line at $1.7 billion. It did, so it came in line. That resulted in a negative 7.1% year over year, which is, given the backdrop of what the companies like Caesars have been reporting in year-over-year revenue drops, that's not as bad here, so a little positive. I'm sure there was some rosy commentary on their earnings conference call regarding, hey, vaccine distribution, economy reopening up, and obviously Caesars does fit what that mentality in the market is, and kind of the price movement we've been seeing just over the last couple of days. Economy reopening up, vaccine distribution, so on and so forth. But again, these raw numbers aren't that positive. We do have a gap up, Tyler, trying to hold that $100 very important price threshold. What's your technical read here?
Well, this is where support and resistance are important. I mean, it's one thing if you gap over resistance. It's another thing if you gap into resistance. Look, if you're going to buy something at the open on a gap, you got to look to the left and make sure there's nothing there to stop it. And in this case, look, the last couple of times we've hit 105, it's rejected the advance. No different this time. Given how much it was up at the open, they decided to read the register. Doesn't mean it can't go higher. It just means it needs some time. I mean, give me a couple of bars up here, digest any sellers coming in, absorb the supply, and then give me a breakout. Could be a better trade in a couple of days, but for now, I think it needs time.
I like that it hit that resistance level and could not break it. I like it. I got a little bit of the same read on Caesars as I have on gold here today, because I feel like if you give me a couple inside candles over the next 2 days, you're going to have a potential breakout coming in for a swing trade, position trade. Because if you look at that weekly chart looks pretty good on a potential breakout. Looks
Yep.
pretty good on a potential breakout. You line up that next couple days, you could have multiple time frame analysis, and we've talked about multiple time frame analysis in the halftime report a lot. I put a lot of emphasis on it. But when you get multiple time frames aligning, typically you have an environment that could be frothy from a price discovery perspective. And I just think those are those moments in time you should be aware of, and you should be in front of the market to take advantage of it. And so whether Caesars does that over the next couple of days, who knows? We don't know. You can, like Coach Frank says, you can only ask for it, and if you get it, you get it. If you don't, you don't. So let's ask for it. Give us a couple inside candles on Caesars over the next couple of days. Line that up really, really nicely for perhaps the scouting report pick coming into the weekend.
Mm-hmm.
Well, and the other thing I'd add too is if it broke out today, then you're chasing it up 9%. I mean,
nobody wants that.
Tough buy when it's up 9% into the breakout. So
yeah, agreed. And then last, certainly not least, because I will be going through a rapid fire technical response from Tyler, but Lyft. Let's take a look at Lyft's earnings very quickly, and a very negative response. They came in at a negative 35 cents versus the expectation of 54. Revenue came in line, resulting in a fairly substantial decrease in revenue year over year. What's your technical read here on Lyft? It feels nasty.
Well, and did you have confidence coming into this when you had it breaking a major support zone ahead of it? I mean,
zero confidence. You're paranoid, delusional, and running for the hills.
And it was justified. So no, it's not a good look. It's a stay away.
Well, let's end on that. It's not a good look because, Tyler, I might have some things that do look good. Let's take a look at TT. And no, that does not stand for tackle trading, but it should, because we are that good of a breakout as well. Tyler, we got a response. I don't even care about the numbers. I'm looking at a high base potential breakout on Trade Technologies here. Give me your technical read.
The fact that this held up so well yesterday, I don't know much about this company, but it tells me it's in this cyclical industrial reopening play area because strong like bull here, right?
100%.
So yes, it looks great. I think. I mean, look, this was up what 145 to 180. It was up $35 into this announcement, and it's going higher. Look, what's not to like? Is this an all-time high too? Yeah, I mean, that weekly chart's gorgeous. It's great. This would be more of a position trading stock for me, kind of a slow and steady grinder. But isn't this what you wanted if you were coming into earnings? You wanted it to break out. It broke out. Volume's going to be higher than average by the end of the day. I like everything about it. Nothing not to like here.
Well, their price response forced me to go look up the numbers, and it's a beat, and an increase in guidance. And so obviously pretty decent numbers coming out of Trend Technology
It's almost
today.
like the market knows something. It's almost like there's a reason why they've been bidding up these types of stocks.
Well, I expect this one to continue. I like that breakout coming out of a high base on a positive catalyst. So keep Trend Technologies on that radar. Let's take a look at Pioneer very quickly in the energy space, PXD. Now, PXD held up a little bit, well, didn't hold up, but really kind of looking fairly similar to Exxon here. Technically, I liked it a little bit better when I was looking at it this morning, Ty. How many times does that happen when you're looking at something in the morning and then you get to it later on in the day and you're like, oh, you had to sell that?
There's a lesson there. There's a big lesson there. Confirmation's only confirmation once you get it, right? Yeah.
So I did like the breakout of 160. You're still on top of 160, Tyler. You're looking at a secondary trigger up above your line. What's that line that you have? What's the number there?
167. Yeah.
167. Let's take a look at the weekly chart. I'm trying to find something that doesn't remind me of Exxon. I'm not. Moving on. Let's go look at Prudential, PRU. Prudential Financial comes out, reports positive response. Tyler, this looks like it's a little bit of an overextended, grindy, methodical. Can you just give us your read here technically on this one?
Yeah, it is extended, and with a position trading type of stock, I think it's a tough entry. But it's notable because it's so dang strong. I mean, the fact that it increased in momentum and it had good earnings just makes me like it that much more on the next setup. whether it bases or pulls back. Just makes me like the next pattern that much more.
It's been an interesting week so far in earnings. Some mixed responses from an earnings, some mixed responses from a price action perspective. But honestly, it goes in line with what we've been seeing this quarter. Really good numbers, not amazing price response to those numbers so far. And again, I do think it fits in line with kind of where we were coming into earnings this quarter, in that, hey, we're looking to justify the previous quarter. And so far passable grade on earnings. If that is the take, we're looking to justify what has transpired so that we can do it again, passable grade.
Okay. Passable grade on Prudential, I guess. Then they've actually had a really
I'm talking
earnings
in general.
I'm also just saying in Prudential in general as well. Is that it, Matty? You got any more that you
Nope, that's it.
Sounds great. I see Mark has popped in here. Mark, obviously, on a Wednesday, it's always great to have you. We were recording this for our halftime crew out there as we were having Zoom issues earlier. But what we're going to do anyway, though, is we're going to have our regular segment we always do here, Tyler, and it's called Jedi Options. And Jedi Options is something I'm kind of geeking out about lately. I love option volatility, option risk graphs, the nature behind the math, and all that kind of stuff. Tyler, what you got today for Jedi Options?
Yeah, we're going to take a look at the energy sector. This is an area that's held up well this week. We talked about crude oil. You take a look today, and a little bit of a wick at the top, but we'll see how it ends up finishing. The point is, when you look from a sector perspective, that you've got pretty good strength out of this area. So look who's on the leaderboard from an ETF perspective. Oil services up 4.5%, breaking out. XLE up 2.5%, oil and gas up 2%. So if I'm looking today at who's strong right now, it's energy. And I like kind of the fundamental thesis that we laid out earlier in the show. So I also like that CLP just had earnings and it's got that out of the way. And it's itching for a little upside breakout here. So I think we could build a trade on CLP.
Okay. So when you're in a situation like this, you've had post earnings, the volatility is going to come down. Obviously, we had that podcast 2 weeks ago talking about the volatility cycles, how different traders interact with it when implied volatility is either cheaper, more expensive. Pretty important when you're building option trades to understand that cycle. So how do you go about approaching a couple of different ways you could play COP?
Yeah. So when the IV is low, essentially what it means is the risk versus reward for buying options is going to be better than the risk versus reward of selling options. So I could structure some kind of cash flow play here, but the premium is going to be less. And that means if I'm wrong, my risk is going to be bigger than my reward. That relationship is even more severe when you have low IV. So I definitely want to be a buyer of options. And the discussion is going to be between a couple of different ways I could structure the trade, depending on preference and how aggressive I want to be.
Okay. All right. So what you got?
So the first thing that I would say from a timing perspective is intraday, if this pop completely fizzles, right? If this just keeps going down for the rest of the day, I'm not doing anything, right? Mm-hmm. So now that the intraday chart has rolled over, this has to bulls have to reassert their dominance. The 5-minute chart has to go back up, which it may in the next couple of hours. I want to see this moving in the right direction when I pull the trigger, okay? Assuming we get that, the question then is, how do you want to go about playing it? So I see a pretty clean shot up towards 60 if they want to press their bets in the energy space. And so what's nice about what's happened in energy for the last month is we had this big pullback, chopped around for a while, and it looks like now, some of these are starting to push through resistance. Yeah, Exxon broke through resistance. Like, this is what I hope Conoco does. Exxon took out resistance. Now it's working its way back up to the next resistance level. That is the path I want COP to follow. And that's going to be kind of what the trade is based off of, is hopefully a push towards 60 in the next month or two. Mm-hmm. So that said, if I take a look here at the trade tab, the name of the game here is to give the panel 2 picks and have them choose kind of which option strategy they prefer. So I got May options, I got June, I got August. I actually wish I had a July. It would give me one more option to play with.
Mhm.
So May's too close. I'm going to stick with June, 44 days. August would give you a little more time. It'd be a little more conservative. But here's my first trade.
Can we do a teaching moment here, if that's okay?
Sure.
Close down that June. There's an option chain in there. And in fact, there's 4 of them that say 146 over 100. Just for a new trader out there, when they come in here, that usually means that there was some kind of split or adjusted from a dividend potentially. There's all kinds of maybe little things that could have caused that. But those are general option chains to avoid, correct, Tyler? Just something that caught my attention visually there.
Yes, yes, because typically, because it's the non-standard contract, it's not going to be as actively traded. And so it means wider bid-ask spreads. It also means the pricing is more funky because if the multiplier is not 100, if it's some ratio or something, then like by default, you usually say, oh, it's $2.50 times 100 because the multiplier is 100. Well, when you get these funky multipliers, it doesn't necessarily cost what you think it would cost. So you come in here and you say, oh, is it 650 times 100? I don't know. And secondly, look at those bid-ask spreads. They're horrific. So that should scare you away from these non-standard contracts. Totally agree.
Okay, good. Anyway, just caught my attention there. Thanks for clarifying.
Yeah.
Go on with the analysis. Yeah.
All right. So going to June, one of the things that I thought was interesting with the implied volatility, remember that when you look at the implied volatility indicator, that is looking at an average of usually 1 month options. So the implied volatility is like the 30-day options. It's looking at volatility expectations 1 month out or supply and demand for 1 month options. And it's looking at a group of strikes around at the money to create this number. Well, if you go one level deeper and you look at each individual option, you'll sometimes see that the implied volatility differs. And remember, low implied volatility means the option is cheaper. Higher implied volatility means the option is more expensive. So if I'm going to build a spread trade where I'm going to buy one option and sell another one against it, I'd like to buy something that has a relatively low IV if possible. And then if I'm selling something against it, it'd be even better if the one I sold had a higher IV. So sometimes you'll see what we call volatility skew, where different strikes will trade at different volatility levels. And you can exploit that if you can structure a trade where you're buying the low IV one and selling the high IV one. So I noticed when I looked at Conoco, again, the June 18th, 44-day options, if you add implied volatility as a column heading, you'll notice that these out-of-the-money calls are trading with higher IV than the at-the-money calls. And that ostensibly is because there's more demand for out-of-the-money calls. People are bidding up the price of those. A good example of this recently was like GameStop, right? Where there was this speculative frenzy, and instead of buying the stock, they were going and buying out-of-the-money call options, and that was bidding up or jacking up the price of those out-of-the-money calls. So in this instance, Tim, I'm going to buy, the stock's at 55. I'm just going to buy an at-the-money call, okay? And its implied volatility is 35%. And I could leave it at that. But I just noticed that this out-of-the-money call has a slightly higher implied volatility. So I'm kind of incentivized to sell that more expensive option against it. And because of both the general level of low IV and the relative difference in IV between these two strikes, the one I'm buying, the one I'm selling, it's going to create a really low cost for this trade, which means the risk is low relative to what's going to be a large reward. So this is just a basic bull call spread. Buy the 55, sell the 60, $5 wide spread, only cost me $1.45, which is cheap. That means I can make about $3.55, which is like a 200% potential return. And I'm only requiring Conoco to get to 60. I'm not requiring it to get to 65 or 70 to make that 200% return. It's only got to get to 60. A bit of an aggressive target for just 44 days of time, but the risk is low, and I like the general payout here.
I like this one as well, and I really like the implied volatility analysis on the strikes that you just did. Hopefully, some people out there learned something right from that analysis. What would we compare it agauld against? So, what would be an alternative way to play this?
Now, I must tell you because I led with the best one here, I'm phoning it in on the second one, okay? Because this is pretty much the one I would do. The logical alternative would be either buy a long call straight up, okay, or do some kind of like poor boys covered call. Where if this is a +2 strategy, moderately bullish, your choice would be doing like a mildly bullish strategy instead, or an aggressively bullish strategy like the +3. Between the two, just because I like higher probability, I would probably do a poor boys covered call. So my alternative would be go buy an August in the money call option, maybe the 50 strike for a 70 delta, and then sell a June out of the money call against it as the covered call. I would drop. See, I don't like paying $6.80 and only bringing in $1. So in a situation like this, I really wish I had a 57.50 strike, because I feel like 55 is too close and 60 is kind of too far away. So this is actually the scenario, just on a teaching note, where I would entertain going to a weekly option to see if I can find the better strike price. So I'll go to the 37-day. This has strikes in 50-cent increments, so I got plenty to choose from. And maybe here I would sell like a 57 strike, get $1.50 instead of the buck I was going to get. That'll reduce my cost a little better. $5 trade. This would be your risk graph.
Well, and I love positive theta, trades that also have the Vega kicker when you're in a cycle with, so the time spread, the diagonalized time spread generally is something I'm open to, but I got to be very, very simple, very blunt. I like that first spread too much. I mean, it's just a simple trade. It's good analysis. You buy the low IV strike at the money. You take advantage of, higher IV further out of the money. You've got a vertical, which is an easier one to execute. So in my estimation, from the two that you're showing us here, the two different ways that we could approach this, I would choose that vertical, and I think it's pretty clear for me. What about you, Matt? You leaning one way or the other on this one?
With the price response that we've had post earnings, and even before earnings in the energy space, there was a little bit of front running behavior before we saw Exxon, Chevron report, and then obviously Conoco reported just this last Monday. But once those European counterparts, you start seeing start seeing breakouts of some minor levels of resistance, but you started seeing things that energy has sold in recent history, and now they're starting to accumulate post what happened a week and a half ago with BP as well as Dutch, and then obviously on the back half of last week with Exxon and Chevron. Now you're looking at an energy space that is showing a little bit of life for the first time in recent history, whereas it's been weaker. It was sold, it hit resistance, gets sold. Now moving averages are now battling with you in this space. You're breaking out of key levels of resistance. You're starting to see a little bit of trend analysis, and because of that, I certainly do. You're never going to say no to a cash flow strategy that fits a bullish philosophy, right? If you're bullish on an area of the market and you have a bullish strategy, you're never going to say no. But there are times that I feel that taking directional risk is appropriate, and this is one of those times. Because of that, I fade to the bull call side.
I love geeking out over volatility numbers, little things like this. Subtlety can make it, but even within the subtlety, verticals
volatility,
are pretty straightforward trades. So I like the vertical here. All right, Tyler.
Outside of direction, is there anything we talk more about than volatility?
Cash flow. Marky brings.
I don't think we do.
Do we?
I do not think we talk about cash flow as much as we talk about volatility in the halftime report.
We love volatility. I do. I know that I do.
And quite frankly, I don't think when people talk about cash flow, they're like just sell a naked put, sell a covered call. They spend 5 seconds talking about it.
Here's my analysis from Tyler's segment. I looked at the 46 strike in June on COP for a naked put.
Like literally,
it took me like 8 seconds. I was like, when he pulled up the option chairs, I was like, I like that 46. I like where it lines up on the chart.
But we will multiple time frame analysis from a 1 minute chart to a monthly chart on a directional position and discussing volatility around earnings. That's all we talk about.
Yep. Yeah. I'm with you. And I love the conversations, to be honest. There's a reason why
I love volatility conversations. I love them.
All right, let's start wrapping the show, out there, guys. Let's make sure that, we kind of get a couple final thoughts here. I know we got Trade Masters tonight. Matt, any final thoughts for the team out there?
No, it's you wanted to see this response after yesterday, right? You wanted to see this snapback. You wanted to see the market play defense. It did. We're not out of the woods yet, right? We haven't really kind of recovered everything. The NASDAQ certainly has some concerns. Comms has some concerns. Discretionary has some concerns. But like Tyler's told me a lot of times in our lives, he says, you know what? Simply because something's going down in a bull market, that means something else is going up, because that rotates, right? You rotate. You don't see aggressive selling one way and then you just see rotation. I think we're seeing a little bit of rotation, back into the cyclical movement, and the cyclical movement has been so strong since the election. I mean, just it's been the number one theme that has carried this much time frame. I mean, guys, I know everybody and their dog talks about the cyclical movement today, and that being a longer term lasting theme. But 6 months ago, when I said that in the halftime report, that this is going to be more long lasting, that this is something I am seeing that does not fit the 2020 rotation themes, that we're seeing something more from a traditional sector rotation. I felt like we at Tackle Trading were on an island and the rest of the market has caught up to that analysis, but it did play out that way, that we weren't swing trading the cyclical movement, that the cyclical movement was legitimate. It has proven out to be legitimate. And even with the NASDAQ, recovering its price over the course of the last 6 weeks, and coming out of that February timeframe that was very, very nerve-wracking, this was a gentle reminder to those participants in the NASDAQ that says, you know what? I get it. You wanted to rotate, but the theme of now, of this moment in time, is cyclical. It's the economy reopening up. It's the vaccine distribution. It's us getting back to our way of life. And technology will have its day in the sun, as it always does. But as of right now, that theme that started 6 months ago and continues today is a cyclical theme.
Tyler, final thoughts from you?
Yeah. So first thought on the directional versus cash flow. So the reason why you like the directional on some stocks, some trades, is because you occasionally get a new core and you can feel much better about it when you do a long call, bull call, versus if you're, down at 75 with a naked put, wondering why in the world you didn't just buy the name stock, right? Really, really, really impressive move in these cyclical names. FCX getting it down again today, 5.5%.
Copper looking to break out again.
Just so nice. So look, if you were heavy in tech this week, you're just not loving life. But if you were in the cyclical names, you're like, sell off. What sell off? I don't know what you guys are complaining about. Fine.
Yeah. FCX, that is such a beautiful chart. And
Can I ask you guys a question, though?
Has been heating up.
I know we're summarizing the final thoughts, Tim, but just one question on Tyler's comment. If you were heavy into tech, shouldn't a February have cured that for most people?
You would think. You would think that you would be forcibly rebalancing several different things as the charts change and adjust. So either somebody's just a huge long-term believer in tech.
Even if you're heavy in tech, you had a weak stretch where you had a technical environment on a breakout.
Yeah.
Like if you're heavy in tech, it's because you didn't rebalance during the sell-off.
I think people who are probably heavy in tech just have their favorite names they like to play. And some of it's probably bias towards the tech sector, which has benefited them for years and years, right? I mean, tech has been a strong leader. And I think sometimes people can get stuck on those biases.
That's fine, but that's not my point.
Yeah. Yeah.
My point is that should have shaken you out in February.
It should have. Yeah. Because
it would have.
Mm-hmm.
It would have. I mean, it would have triggered stop losses, would have triggered. I mean, when you're looking at an index like this, it doesn't even tell the story of the true bloodbath that's happening in the stocks.
Oh, especially like those ARC stocks that took it on the chin, and all those high-flying names like Zillow. We did Zillow earnings today, and how far that thing has come down from the highs. Those high flying momentum
If
stocks.
if a downward movement in price that we saw in February didn't shake you out, and one downward movement in price in May shakes you out, I don't even know what to say.
You don't know what the process is. You're right. My comment was more in reference to if you had just in the last week or two, let's say on Monday, or you had carried it from last week as a swing trade.
Yeah.
Anybody in tech got stopped out of swing trades this week. Anybody
Oh,
in cyclicals
100%.
did
Yeah,
not.
that's not my like. Yeah, everybody had swing trades, right? Yeah, you got stopped out on those swing trades. That's not what I'm saying. I'm talking about a rebalancing in the portfolio. Wasn't that cured in February?
Man, I hope so.
I would
And
agree.
I hope they've been curing it all year. There've been so many strong areas of the market you should have been accumulating and targeting and picking up, like those
Well,
cyclical
and by the way,
names
I'm
that
not
we've been
bearish
talking
on
about.
tech.
Not me either, but I love some of the other areas, and I think that's natural as things get exciting. You start adding the energy stocks, you start adding the material stocks.
Again, I just want to be clear here. I completely understand that balancing conversation coming into February, because what was driving up in price so much was those areas of the market, the technology stocks, discretionary, not so much discretionary, but technology stocks, those, the memes and the SPACs and the underbelly and all that jazz. But once that got blasted in February, what, people just said, okay, we're going to recreate? No,
I don't think so. Marky, any final thoughts from you? Promote tonight, I guess, for anybody out there watching the recording.
I love Trade Masters so much. 7 o'clock Eastern tonight. I love the ideas. I love ideas in environments that aren't easy. In particular, last time we had volatility in the marketplace, Tyler, Greg, the other coaches that did Trade Masters, they brought some great ideas that match the marketplace. And so I'm really excited to see what they bring tonight. Trade Masters 7 o'clock Eastern, and then Trading Lounge at 8:30 Eastern for pro members right following it.
Fantastic. All right, Team Tackle out there, appreciate you guys as always. We'll be back tomorrow, same time, same station. Till then, we will see you on the other side.